Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, December 11th, and you are tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to look at the broad market ETFs first, then we'll go through the sector SPDRs and show you finance is weighing, but technology's holding up a little bit. Treasuries continue to catch a bid while junk remains weak. We'll look at some tech-related ETFs and finish with stocks to watch. Let's start by looking at some of the recent triangle breaks in SPY, MDY, and IJR. So I'm going to start off with the S&P 500, which of course is my main barometer for the stock market. It is the most widely followed benchmark for U.S. stocks, and SPY is the trading equivalent of that benchmark index. And my current stance on the market is bearish at worst and not bullish at best. And so that either way, that means you got to be very selective in this market environment if you want to be long stocks. If you want to be short stocks, that's another question, because shorting is a completely different ball game and it carries much more risk than being long during an uptrend. Yes, being short during a bear market environment or a not bullish environment is much riskier than being long. And so it is about risk taking. And I don't think the market environment right now favors risk taking. As you can see, we had the breakdown there with the sharp decline in October, and that's when the breadth indicators turned bearish in mid-October. And since we moved from a bullish environment all the way up to September, from basically April, May to September, to a bearish or not bullish environment, you can see how things have changed. We've had these massive swings, down 5% or more, up 5% or more, down, up, down. And you have to ask yourself, is this the kind of environment I want to be active in? Now, if you're an aggressive trader that, likes to sell short near peaks and buy near troughs and take your profits quick and watch the market during the day, maybe this is something for you. But I'm not that kind of a trader, so this really isn't my cup of tea right now. I prefer a bull market environment and looking for long positions than this current market environment. Now, if we look at this pattern here, basically we have the big move down, which is the breakdown. Then we have this kind of consolidation. You can see we had three gaps above 276 and all three failed. And then we broke below this lower line of what looks like the triangle consolidation. But who knows what is going to happen inside this consolidation. I mean, look at these swings. Okay, we could continue lower and move to new lows, and I suspect that's eventually what will happen because of the broader market environment is negative. But we could bounce up to the mid 275 area in the meantime, the mid 270s. Now, if you look at the indicator window, you can see that it shows RSI, and this is just basic 14-period RSI. But RSI does tend to range when the market is trending in a certain direction. And so you can see when, it was trending higher, it hit 70 on numerous occasions, and then it started hitting 30 in October twice, and it couldn't get above this 60 level. So it's stuck in the lower 60% of its range, which is 0 to 100. And that kind of infirms that the overall trajectory is still down for the S&P 500. Now, if we look at QQQ, we can see a big wedge taking shape. And I highlighted this pattern before, but we got a failure here. We got a gap up and then a reversal down. And then we got another gap up and another reversal down. Now, QQQ is holding up a little bit better just for the simple reason that you can see that it's above this low here from late November to mid-December. It held above that low. So that's a sign of less weakness. So if we can get a follow-through breakout at 167, that would be short-term bullish, and then you get a breakout at 174, that would be even more bullish, but we'll cross that bridge when and if it gets here. And later on, I got some tech-related ETFs to show you. Now, in the indicator window, again, you can see RSI. It can't get above that 60 level, so it remains in the lower part of its range. We got more weakness coming from mid caps and small caps, and those, of course, are more domestically oriented. There's the triangle formations that we have and a clear break below that triangle line with a gap down last week, and that's a lower low. And there you can see the contrasting lows that I was just talking about with QQQ, where you had a higher low from late November to mid-December, whereas in MDY you have a lower low. And then there's that 60 level holding for RSI. And then we look at IJR, which of course represents small caps. You can see here a similar dynamic at work here. You got the triangle break there. And, maybe we get a little throwback and then resistance and another leg lower. But, this looks like the initial move down, a consolidation, and some sort of continuation break. Now we're going to run down the 11 sector SPDRs and see that finance, industrials, and energy are leading lower. So I've talked about benchmark lows before, and you can set a low and call it a benchmark low. So I'm setting this November low as a benchmark low. So any ETF or stock that held above that low after this December decline shows less weakness on this decline that we had last week, basically. So anything that is showing a little bit of less weakness could be poised to lead if we get a bounce in the stock market. But, keep in mind that big caveat, of course, is my broad market stance is bearish at worst and not bullish at best. So you can see this is XLY, and it's showing a little bit of less weakness over the last few weeks, of course, led by Amazon, which I'm going to highlight a little bit later here. But you can see a clear resistance zone there in that 111, 112 area. And we can also see the 50-day crossing below the 200-day moving average, price well below the 200-day moving average, and failures in the 60 zone for RSI. So, the overall outlook here for XLY is clearly not positive. We'll look at communication services. This one has been leading lower for quite some time here. You can see that it peaked back there in July. It only started trading on June 19th and moved up. And since then, it's just been moving pretty much solidly down. And then you can see the 50-day crossing below the 200-day there. And you can see resistance around, we'll call it, 46, 46 and a half. Even though a little bit of less weakness because it's holding above that low there. But, you got to get a break above 44 and a half to get that bounce within a bigger downtrend. That's the whole problem here. The bigger trends are down. The broad market evidence is bearish. So you're really fighting. You got a headwind with this bigger downtrend if you're trying to play an oversold bounce. And then you can see RSI hasn't been above 60 since July. That's how weak this one is. Then we look at technology XLK. All right, it is holding above that November low there, just barely. You got the week open on Monday and a fairly strong close. So, maybe we get a bounce, but still it's a bounce within a bigger downtrend and a lot of resistance coming in there in that 69.70 area. And there you can see RSI hasn't been above 60 since the early part of October. And now we get into the weaker part of the market, the leaders on the downside. All right, finance hit a 52-week low. And there you can see there's that late November low, and there's that December low, and it's a lower low. Finance was holding up pretty good at this stage, but then just gave it all back. That's how fragile this current market environment is. So, maybe we close off the low and maybe we get a bounce back into this zone. But, is this on trend? Well, it's on a downtrend, if anything. It's clearly not on an uptrend. If it's not on an uptrend, I don't want to be involved. But it's clearly weighing on the market, and it's 13.8% of SPY there. Then you look at industrials, and we can see another 52-week low intraday there. So there's that late November low. So it's a lower low and kind of a wedge break. But you can see it's just a mess here. Below 70, above 70, below 70, above 70, below. Maybe we go back above 70 now. Again, is this the kind of trend you want to be involved in? For me, no. I just move on. It's bear market stuff. It's volatility. It's not a healthy environment right now. You look at materials, they're one of the weaker sectors. You know, even though they were holding up at this point better than some of the sectors, you can see you had the death cross there in October with this one and a clear support break there. So didn't even get back to the support break as you failed in that 56 area and plunged. So nothing going on here. Now I'll move on to the next page. Another laggard or leader on the downside would be energy. All right, you can see here XLE is got a 52-week low, and there's that November low that we talked about, the benchmark low. Well, it's got a lower low, so it's leading on the way down. Not interested in energy. Now we get to some of the ones that are holding up. That would, of course, be healthcare, staples, utilities, and REITs. But healthcare, you know, even though it's holding up, it's still gone nowhere over the last 3 months. It's in the middle of its range. So, you know, there are places to hide out, but it's very hard to get any upside momentum going here or sustained when you're an equity, a stock, because you're part of the stock market, and the stock market on the weight of the evidence is bearish at best and not bullish at worst. But, you know, healthcare is holding up much better. It's above the 200-day and the 50 days above the 200-day. And there you can see that November low. It's testing it, or it tested it yesterday. Now we look at consumer staples. You know, here's another one. It's holding up, but it's gone nowhere since the middle of August. It's pretty much unchanged. So, yeah, you could have hidden out, but would you have had any gains? No, you wouldn't have. Utilities, you would have had some small gains. All right, you can see there it's been working its way higher with higher highs, and it's near a 52-week high. So utilities still holding the uptrend and outperforming. And REITs still holding the uptrend and outperforming. You can see there that just above that August high. So you got a small gain since August. But, you know, since the market's been in turmoil in August, it's risen. But if you go back to August, it's barely up. So again, it's a struggle just being in any kind of equity. Now this chart here shows high-low percent for the 9 sectors, and it's the old sector alignment that was earlier this summer. So we don't have REITs and communication services broken out in this alignment, but we can still get good information out of it. And in particular, look at technology, okay? If you look at the number of new lows that we had yesterday, well, technology had fewer new lows here in early December than it did in November and that it did in October. So the technology sector is actually holding up a little bit better here in December. So if we do get a bounce, maybe technology will lead. All right, utilities is still the strongest sector as far as the number of new highs. And then when we go down the list, we can see healthcare had an expansion of new lows, but it's still overall bullish. I mean, I count this as a bullish signal when it goes above plus 10%, which it did over a year ago. And it's a bearish signal when it goes below minus 10%, which it hadn't. But you can see industrials went below minus 10% there in October for a bearish signal, and they're one of the weaker sectors. Consumer discretionary did as well. It popped back above plus 10% in November, but back down below minus 10%. And what I also want to point out is consumer staples and finance. Because, you know, you think the consumer staples sector is holding up, but look at that expansion of new lows over the last 3 days. All right, it's below minus 10% 3 days in a row. So that tells you there's a lot of new lows in the consumer staples sector. So that's not a sector I'd want to be involved in. And then you look at finance. Okay, high-low percent is at minus 55%. So that tells me that over 50% of the stocks in the finance sector hit new lows. That is not a good sign for the broader market. Banks are weighing on the market. We'll also look at the high yield spread as well as the Fed balance sheet chart. So the finance sector has just been decimated, and we're going to look at some finance-related ETFs. Here's the broker-dealer iShares. You know, it peaked way back here in March, had lower highs there in May, June, and then a clear breakdown in September and a new 52-week low. So that clearly is not a good sign for the broader market. And then you look at the Vanguard Financials ETF. It also hit a 52-week low and is leading the market lower. Then we look at insurance. Insurance has been all over the place over the past year. You can see it's been above and below that midpoint, and then it finally moved to another 52-week low with a sharp decline last week and into Monday. And then the only highlight in the finance group would be something like mortgage REITs, which is part of the REIT group. And you can see this mortgage REIT ETF broke out there in October, held the breakout. So, you know, it's not going anywhere really, but it is holding up and holding that breakout. And then we look at regional banks. I mean, this one is really getting clobbered. And you can see here that the KRE broke down there in October to lead the way. You know, that was a multi-month low to new lows for 2018, and then 52-week lows in October and again in December. So banks are clearly leading the way lower. So I know this is more getting into the fundamental side of the market, but, you know, it confirms what we're seeing in the technicals or on the charts. So, you know, here's the Board of Governors of the Federal Reserve System website, and it talks about their balance sheet. If you want to know what it is, go here and you can learn about it, or Google it. And if you go down and you look at that chart, you can see that it has been declining since 2018, and it hit a new low for the move. So that means the balance sheet is shrinking, and that I think is weighing on the market. And then maybe more importantly is there is tightness in the credit markets. I'm on the Fred website for economic research. And if you look at this spread between junk bonds and higher credit names, you can see that spread has widened considerably since October, and it took a big surge this past week. So it's at its highest level in a while. You can open these charts up if you want to see more history. But, you know, we've got a big move up, and that tells you that investors, traders, whatever, are demanding more yield from their junk bonds, and that suggests some tightness in the credit markets, and that could be why banks are so weak right now. Money continues to move into treasuries, and junk bonds remain weak. So here's a chart showing TLT and the junk bond ETF HYG. TLT in the top. This is unadjusted data. And you can see that TLT has rallied from 112 to 119 over the past 5 weeks or so. And at the same time, junk bonds have fallen. So that tells you that money's moving into safety, treasury yields, treasury bonds, and is moving out of riskier assets like junk bonds. And then when we look at the Treasury bond ETFs, there you can see IEF has broken above its 200-day moving average with a big move from the early part of November here to early part of December. And the 10-year Treasury yield has fallen below 3% and below its 200-day moving average. And then if we look at TLT, we can see a similar move happening here. TLT just moved above its 200-day moving average, so the long end of the curve is playing a little bit of catch up here. But there you can see clearly a move above that 200-day for TLT and a move below the 200-day for the 30-year Treasury yield. And so that tells us, you know, a number of things, possibly lower inflationary expectations because of the decline in crude oil. An outlook for economic growth has deteriorated or declined, and that could be for a number of reasons. All right, so even though the Fed, is saying and doing what it does, the bond market is telling you that rates are moving lower, and that means there could be challenges out there in the economy. And it's just not U.S. yields that are moving lower. Here we've got the 10-year Treasury yield for the U.S., and it is still far and away the highest of the four that I have on this chart, but it has fallen over the last 5 weeks. But the UK 10-year yield has been falling since the middle part of October. And the German 10-year has actually been falling since February, all right? And it started its decline again in October. And even the Japanese 10-year has been moving lower. So yields around the world are falling, and that again suggests that maybe economic growth is waning. Tech-related ETFs are holding up a little bit better, but there is a caveat. So I mentioned that some tech-related ETFs were holding up better than the broader market over the last few weeks, and we saw that there were fewer new lows in the technology sector than the other sectors yesterday and last week. And if we look at SKY, this is the cloud computing ETF, there's that benchmark low from November, and you can see we didn't go below that low, held above that low on this dip. And the fact that we didn't make a lower low tells you that there's a little bit of less weakness, which translates into a little bit of relative chart strength. And if you look at this on a weekly chart, you can see that, maybe this is a wedge correction after a massive advance, because there was a massive advance leading into that September high, which was a 52-week high. And now we have this falling wedge type pattern, which is typically a correction after a big advance. We have a little bit of relative strength. So if you get a bounce here, that would be the first sign, and a breakout at 53 would be bullish for cloud computing. So we'll be watching these. Another one would be the cybersecurity ETF hack, and we can see a similar pattern emerging here. Again, we've got the wedge, and then there's that low from November, and we're holding well above that low here in December. So a little bit of relative strength, firming. So if we get a breakout there, that could lead to a reversal and a further move higher in hack. And I'm pointing this out because, even though the market environment is not so good, you always have to keep an eye on things. You got to see what's holding up, what's not. We know that finance is not holding up. We know that utilities and staples aren't that great, lots of new lows in staples. But here we're seeing some relative strength in hack and SKY, and I'll get to software next. So these are the ones to keep an eye on for a potential bounce if we get one here. And so I'll go next to software because I think that is the other one that is holding up better when I look at the technology-related ETFs. So look at that bounce we got in software. And then we got the pullback, and again, we're holding well above that November low. And so watch for another bounce and a breakout there to suggest software is leading. Now, I think you still got to be careful. As I said, that's the big caveat out there. It's the broad market environment because the bear eventually takes everything with it. That's what you have to watch out for to see if a bear market is expanding. If we look at the First Trust Internet ETF, another tech-related ETF, again, there's that November low, and there's the December low holding above it and firming. Now, it was one of the first to break down here in October, but, a breakout there would be positive. And then if we look at some of the other ones here, networking, I just throw my hands up at networking because it is just a volatile ETF, and I move on. Semiconductors, throw my hands up because of the 52-week low there. So we want to stay away from things that have 52-week lows within a 2-month period. Maybe firming, maybe we get a bounce. But I think the other ones, hack, SKY, and software, IGV, look better. And then if we look at the XSD, the broader semiconductor ETF, come on. Is this on trend? No way. At best, you're in the bottom half of the 1-year range. but you're moving above and below the 70 level quite often and not going anywhere. Whereas, we do have a choice. If you have to pick a technology ETF, semiconductors are out the window, networking's out the window, first just internet's out the window because it's broke down the earliest. So that leaves those first three that I talked about. And we'll finish with some stocks to watch, including AMZN and BIIB. All right, so the first one we're going to start off with is Amazon, and it is the biggest stock in the consumer discretionary SPDR XLY. And there you can see we have perhaps a big wedge. And keep in mind, this was just a monster advance up to that August high. So this pullback below the 200-day, yeah, it did break the 200-day, but it's battling that zone. And there's that low in November, and it's holding way above that low with this December pullback here. So it is showing a little bit of relative strength. So watch for a bounce here and maybe a continuation higher for Amazon. Then we look at Biogen IDEC. It's part of the healthcare sector, which is one of the stronger ones. Biotech is all over the place in general. But, it's above the 200-day barely, 50 days above the 200-day. And you can see this, kind of resistance zone here that it's trying to challenge as it holds this gap zone and the 200-day with this little consolidation. So I'm watching to see if we get a bounce off support here that could signal a continuation higher and further strength for Biogen here. Then we look at Sienna, and this is part of a networking trio that I've got here. I've got Juniper and Cisco as well coming up. But, Sienna's holding up really well with this zigzag advance. You got the pullback. You held above that November low with this December pullback here. So watch for a bounce above 33 to get Sienna's uptrend back on track. Then we look at Comcast. This is a boring stock, but boring seems to be in right now. It lagged in the first part of the year, and it's leading in the second part of the year. And you can see it broke above that October high there. So it's got a pullback working, but look for a bounce to continue that move up. Cisco is continuing to show relative and absolute strength. It's in a clear uptrend here with a 52-week high in September. And then this looks like a triangle consolidation within that uptrend. We broke out, but broad market weakness led to the pullback. So we're back in the middle of this range where we may find support and continue higher on Cisco. H&R Block. Now this one is a weird one. It's not technology. It's kind of got its own thing going. It's kind of been going nowhere for a long time there. But it is holding up relatively well recently. In particular, you can see we got this kind of consolidation, and then we got the breakout, and then a throwback to the breakout zone. And look at that big move up yesterday. So it's got a lot of congestion in here to mark support, and it looks like it could be some sort of a flag type pattern. So watch for a breakout there in H&R Block. Then we got some healthcare stocks that are continuing to perform well. Johnson & Johnson holding its uptrend and above its 50-day and 200-day. This is the other networker, Juniper. You can see that it is testing support here from these lows, but the 50 days above the 200-day and prices above the 200-day. Then we look at Eli Lilly, another one of the strong healthcare stocks, and Merck, another one of the strong healthcare stocks. All right, that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.